back to Dateline New Haven on WNHH New Haven's home for community radio. I'm Paul Bass, inviting you to look behind the headlines on the stories that make New Haven tick. And one of the stories, the big stories in town right now, is the proposed budget, new budget for the city with 11% tax increase. And even limiting it to that tax increase is going to require some heavy lifts. So our city, our elected representatives are in the last few weeks of considering whether to approve it or whether to amend it. And the fellow we have in the studio today is playing a huge role in that public debate about what to do. His name is Mohit Agrawal. Did I say last name right?
That's exactly right.
Mohit Agrawal, who is chairing an important group in New Haven that we often don't hear about, but we're hearing about a lot these days, especially if you read the New Haven Independent. He chairs the Financial Review and Audit Commission, FRAC. That's an independent budget watchdog agency the government set up not to control, but to hear back from some folks who pay a lot of attention to numbers to see how we're doing with our budgets and if there are any landmines we got to look out for. So in that role, Mohit and FRAC have been looking closely at the budget. And today is, if you're listening to us live, it's Wednesday. Tomorrow night, I guess Thursday night's a big board of alders meeting about it. I think Wednesday night there's a budget hearing.
Thursday night.
6
p.m. in the Aldermanic Chambers.
About the budget, and FRAC is going to meet as well. And you've been sending a warning signal out, Mohit. First of all, thank you for coming. Welcome to the studio.
Thank you.
On a number of aspects of this budget, you think that the proposed budget submitted by Mayor Hart has some big question marks in it. Might not work out the way they said it would. And one big question mark is this idea that we're going to deal with our pension, which is dangerously underfunded for teachers and other city workers, 2 pension funds, by borrowing $250 million, floating what are called pension obligation bonds, POBs. Ready? Like TCB of POB here. We're going to pension obligation bonds. So as chair of FRAC, do you think it's a good idea that New Haven borrow $250 million to try to shore up its pension funds?
Sure. So let me just start with an overview of the pension funds.
Yeah.
So our pension funds are about $900 million underfunded. We're about 40% funded in our 2 pension funds, police and fire, and serve the city employees retirement fund. So that's a pretty significant situation that we as a city have to address. Our city's total.
And why does that matter? Because there's no short term that we're going to not be able to pay the bills. But as I understand it, because every city, every state, almost in the country, are dealing with this. Not everyone, but close to it, having way underfunded pensions because politicians want to get reelected and spend money now rather than put enough money in. The immediate danger, right, is that ratings agencies say your budget's not in good shape, your finances, so they charge us more to borrow money. So that takes money out of our budget that we could use to fix schools or in New Haven, help the poor and housing. Long term, though, there is also a threat that one day we wouldn't be able to pay everyone's pensions, right?
Sure. So you're absolutely right about what some of the threats are regarding our pension funds. So what happens when our pension funds are underfunded, particularly when they're 60% underfunded, is that we're required by law to fund them. And state law and accounting rules require that pensions be funded as you go rather than paid out of the budget when people retire. So pensions have to be, in some sense, pre-funded.
And at what percent? Rather than 40%, what should they be?
I mean, the number should be 100, but even that number is a little bit squishy.
But there's an industry standard, though, that is not 100. Like, isn't it true that if you're 80% funded, the ratings agency think you're doing great?
That's right. 80, 85%, and then.
And why would you not need 100%?
So even the 100% is a bit squishy, and those numbers come from 2 different sets of assumptions. One assumption is what's called the assumed return rate, and the 100% number. So the underlying number beneath that depends on some of these assumptions. And so
meaning how much you're going to turn every year when you invest those
pension
funds.
And so, in my opinion, 100% would still put the city at a little bit of risk because we're still assuming a 7.5% return. And looking forward over the next 30 years, the U.S. is a developed economy, and we're probably not going to be seeing the 7.5% returns, the 8% returns that pension funds got back in the 60s.
But we haven't gotten those for years, but government agencies still go up. Even the state, they've gone as high as 8. One of our pension funds is 4.85% assumption, right? And the other is 7.5.
The 4.85% is the interest rate assumption on what the POBs might be.
Oh, okay.
So I believe.
And we're saying we can beat them. So what the city is saying, Mohit, is that, okay, we have a problem being underfunded. The way we're going to solve it is we're going to be real savvy. We're going to go borrow all this money that gets us money in the short term. But in meanwhile, we're going to invest that money, and we're going to get 7.5% back, and only have to pay 4.85 on it, so there'll be a spread.
Exactly. That's the city's argument, and that is the general argument made in favor of pension obligation bonds. The risk, of course, is that those aren't the right numbers, particularly the 7.5% return. That number not only is probably too high, that's also a very risky number. So in some years, it's going to be a negative 20. In other years, it's going to be a positive 40. And so
in other words, but we know we're going to pay 4.85%
Exactly.
if we borrow that money.
Exactly.
So we have to do better than that, which we won't necessarily do.
Exactly. And then the 4.85%, we've looked at the POBs up in Hamden and this current trading around those POBs in the secondary market. 4.85% might be a little bit low. That number might be closer to 5.1 or 5.2. Markets, interest rates in the markets have been going up pretty dramatically in the last couple of months.
Why would the markets allow us to borrow money that we can make money on when they could just make the money themselves?
That's a very good argument. So under what's called the efficient markets hypothesis, there should be no scope for arbitrage. So what this means is there's no free money. You can't just borrow money and then make money on it by investing it elsewhere in another risk-free security. So you're
Unless
exactly
you're David
right.
Swenson. I mean, Yale has a way. Yale always beating the averages and returns, but somebody else then has to unbeat the averages.
Oh, absolutely. Yes.
So
you're absolutely right
so
about
it's really a vision of government, right? Do we believe we're so slick, even though we can hardly pay to have the top talent in investment the way other people can if they're a 23 or whatever $billion corporation like Yale, that we're somehow going to be smarter than the market?
You're absolutely
We're
right.
gambling.
So you bring up another point here, which is what is the right investment strategy for the city? And right now, the city is on an active footing. The city is trying to beat the markets. We are trying. We've hired investment managers. We're trying to get into aggressive pension funds, hedge funds, actively managed mutual funds. Yes,
Wow.
exactly right. So we are in alternative investments, and the city's really trying to go for returns.
Maybe
and
I'm
that's
wrong,
risky.
but I think of the hedge fund craze now, which is really, I thought, originally geared to sophisticated investors. Hedge funds started serving very, very, very super wealthy, not the 1%, like the 1/10, the 1%, who don't need the protections that other people need when they invest in the market to protect the safety
That's
of
right.
their money. So, it won't all
Our pension
disappear.
funds are considered qualified investors, so they're allowed to invest in these kinds of securities.
Wow, but that's really gambling.
Oh, absolutely. Another one of the points that FRAC has made is that we're a little bit uncomfortable with the city's aggressive investment stance, and we believe a passive investment strategy where most of our money is kept in index funds where we meet the average. We're not trying to beat
Meaning
it in
what?
that
That's
case.
when you go into somebody invests your money in a whole lot of stocks that represent the
Exactly.
breadth of what's in the stock market.
Exactly.
And
So the
therefore,
gold
on
standard here
average,
is-
you're going to get the average
That's right.
returns.
The gold standard here is Vanguard, so they're a non-profit cooperative. So they have some of the lowest costs in the business. We're not exactly sure what the costs are on our active investments right now, but so there's two problems here with active investments. One is the risk inherent in active investments, and the other problem is that there's a lot of fees. We're paying managers a lot of money in order to do these trades for us. And so with passive investments, we save on the fees and hopefully we meet the average, and that's the point of a passive security. So
And what do they return? What do they bring back on average, Vanguard?
So it depends on which index funds you choose to go into, but the point is they meet the average. They meet the market average,
Mhm.
right? And
What is the market average?
so it depends on the risk you choose to take in your portfolio. So by that I mean what percentage of your portfolio is in stocks and what percentage in bonds. If you're in a 60-40 stock bond mix, which is pretty standard for individual retirees, investors, then you're looking at 7-8% returns over time.
Oh, wow.
But the city won't be able to get that. Why? Because we have much higher liquidity needs. So we can't
We
keep-
need to have more cash on hand to pay those
Exactly.
pensions.
Exactly. And so, we believe that for the city, the last 10 years we've returned somewhere in the high fives. That's not unreasonable. If we can really look carefully at the costs we have in our pension funds and try to reduce some of these costs related to our active investment, we might be able to add 10 basis points, 20 basis points. That's 0.1 or 0.2% returns. It's not going to, fix the problem overnight. It's probably not going to fix the problem at all. But, we think it's a prudent choice to make. And so, going back to the POBs, the city's put forward a list of suggestions for reforms in addition to pursuing the POBs. And we think these are good reforms. So it's important to bring labor to the table and discuss, what is the feasibility of these pension funds and what can we do to make them more feasible? And it looks like the city is willing to have that conversation. That's an important conversation to have. And my point would be there's no reason to wait for the POBs to have that conversation.
And we're having the conversation about how to make our budget balance in New Haven without going broke and without stiffing retirees. And we're having that conversation with Mohit Agrawal, who runs the Financial Review and Audit Commission FRAC. That means he's our person at the table it's hired, I mean, commissioned by government, it's unpaid, to watch what's going to happen with our budget, how we spend our money, and whether it's being done in the right way. And he has become a critical voice of the city administration's plan to try to borrow $250 million to shore up our drastically underfunded pensions. So we talked about how you said if we go to a conservative investing strategy, which is my personal approach to life, so that you know you're not going to be
It's also
in
David
danger.
Swenson's. If you ask him what to do with city pension funds.
But he also takes helicopter rides in Africa to find out something no one else is looking at to get a wildly great return on something.
And he is. And, there are places like Yale that can do that.
Yeah.
But that's probably not the right strategy. And, our city is not supposed to be an investment fund that also happens to run schools. I mean, people say that about Yale. Our city should be a city first, and then the pension funds
And
should
be good at
secondary.
what we're good at.
Exactly.
So if it doesn't fix the problem, we have to talk about what will fix the problem. Now, one thing you brought up was concessions by labor. If we have pension plans that are too generous to be able to meet the cost, which is a big debate, you're not going to get far in the public arena with cutting back pensions. We've done it for newer hires, and as a result, we're losing all our cops. Any newer hire cop says, I don't want the new pension plan.
And I've talked to cops who've said the same thing, that they came to the city because of the pension promises.
So what do we do? How do we?
It's a tough question. There are a few small changes to the pension plan that could save a lot of money over time. The big one people have talked about is called COLAs. So
Cost of living increases.
Exactly. This is the inflation adjustments made on a year-by-year basis. And, pulling those, there's different indices you might use to do a COLA.
And do we use an index that is higher than is accurate?
It's a good question.
How do you peg?
Exactly. What is
because
accurate?
economics is an imprecise science, and what you peg a cost of living is going to be the price of sugar. I mean, they look at a bunch of products to see how much they go up, right?
Exactly. And so there's various indices, and there's a lot of.
But there's no free lunch, as you say. What you're really trying to do is saying, are we going to give you less than we said we're going to give, or more by picking which cola? Yeah.
So with colas,
and gambling that it'll stay that way, that there won't be
exactly.
OPEC won't suddenly raise oil prices, and we're depending on that for the cola.
So with you're absolutely right. There are no free lunches, and with the pension plans, it's important to consider what we're able to pay, and really try to make sure that we can afford those promises. And my fear is bigger than the pension plans, right? So let's talk about the city's liabilities. The city has about $2 billion that it owes across its bonds. So these are bonds for capital projects, across our pension liabilities that already exist, and then we have another bucket called OPEB, other post-employment benefits. That we've only just started saving for. So we have about a $400 million gap there. So that's about $2 billion all put together. And, pensions are about half of that. I mean, other retirement as well, it's about 2/3. And so what does that mean? It means that, our retirement costs are important. But at the same time, let's compare that number to other cities. Now, a $2 billion liability for the city is really high. And so, we don't have a short-term crisis. I agree with that. We have cash in the bank. We have over 80 million in the bank. We have accounts receivable. We have about 150 essentially of cash on hand, million of cash on hand. So we don't have an immediate crisis. But, we need to be thinking down the line, because the last thing we want is for the city.
We don't want to be Hartford needing the bailout from the state.
Yeah, well, talking about Hartford, if you were to ask someone from outside the state to look at two sets of numbers, one from New Haven and one from Hartford, and say that, one of these cities thinks that they're doing okay, and the other one just got a bailout, I think it'd be really hard to say which one's which.
Really?
We have more in liabilities than the city of Hartford does.
So why did they need the bailout and we didn't?
I think they were just looking forward and seeing the same situation we do. And
they also assessed their property at 30%.
Yeah,
so
I looked at the equal. You're absolutely right that there are some, some let's call it, adjustments made to their property tax system. But on an equalized basis, they do have higher property taxes than we do. I'm not sure that's true for homeowners.
So are there there's another way that you meet your obligations, which is you put more money into the pension fund.
Absolutely.
Now, the danger there is that you have to cut huge parts of government that services people need. Some people think you just cut all administrators, but nobody ever tells you what administrators in any meaningful way. Maybe you've come up with a list. We shrunk government a lot. Should we shrink it a lot more, or can we raise taxes? Or do people say we're already taxed too much in New Haven because so much of our property is non-taxable because of tax-exempt institutions that own it, that if we're actually not going to raise more money if we raise taxes because people will move out or be unpaid? Or is that just not true? Should we be raising taxes to put more money in these pension funds?
So a couple points there. One is, on an equalized basis, our taxes are probably a little bit lower than Hartford and Bridgeport. So at least when it comes, at least in the eyes of the General Assembly and others who we're going to have to depend on to help us in this situation, they're probably going to say that property taxes need to be part of the solution.
Will that still be the case if we raise them 11% this year?
Yes, it will.
We'll still be having lower taxes than Hartford and then Hampden, right, as well.
I'm not sure about Hampden, but
Hartford and Bridgeport.
yeah, on an equalized basis, we're about
You have to look at when
20%
property
lower.
was assessed.
Yeah.
20% lower.
Lower than Hartford, at least according to the numbers I've seen. Looking at these yesterday.
So do you think we need to raise taxes even more than the 11%?
So if we want to afford the services that the mayor's budget puts forward, then our number is that we need a mill rate of at least 47.2.
And what do we have now?
We're 38.68, and the mayor's proposing, I think it's 42 something, just about 43. And so that would have to get bumped up to.
You'd have a revolt.
Oh, absolutely.
White people would burn down New Haven City Hall. So you would therefore cut a lot of services, right?
I mean, it's really hard for us to say, because what we can point out is that on a short-term basis, in the the proposed budget, there's going to be $27 to $50 million in overages, and so we need to figure out how to balance that. On a long-term basis, we also have these long-term liabilities. These $2 billion that are going to be coming due over the next 30 years. So we're in a serious situation, but at the same time, we're not in an immediate liquidity crisis. We do have cash on hand, so we do have some time, maybe a few years, to really think about some of these solutions carefully. And
but to take the hard question here, would you cut a big chunk of government? Would you just get out of the cleaning parks business? Would you get out of the school security business? What would you do?
So at the end of the day, what's the problem? One side is we need more revenue. The other side is we need lower costs. And on what side we really
Your
push,
answer is yes.
Is yes to an all the above solution. But let me make a couple points. One is we really need to work carefully with our state delegation and make sure we get fully funded pilots. I think
happening.
But I think that's the starting solution here, is that we need to have a productive relationship with the state. And right now,
payments in lieu of taxes.
Exactly.
And we're talking about that Mohit Agrawal, who's the head of FRAC. That's our independent budget watchdog. Before you go, Mohit, I just want to talk about you. So you have an interesting bio. You were in the basement in 2012. You were in the famous dark basement where people's eyes were turning into orbs.
It was really next door, but yeah.
Oh, you were next. So you were part of the big data team, data analysis for President Obama's re-election campaign.
Yeah, we call that the cave. Yeah, that's right.
The famous cave where people pioneered the use of big data. And my favorite example was Mitt Romney spent millions of dollars in television commercials to reach a lot of people. You guys in the basement decided which swing voters in which state watched which TV show on cable when they got home off the second shift. And you narrowed down who really needed to be reached and how. You spent a lot less money on ads that reached a high percentage of whom you need to reach. It's the way that Facebook ads can reach people who like bands that go to Toads in 40 miles for a lot less money than a general newspaper ad. Is that accurate?
I will give full credit to the TV team for doing that part. But
what was the TV show and what was the state?
So the story that's most famous is 2 a.m. in the morning that there's a lot of shift workers coming back in Ohio from the 4 to midnight shift. And so what we found was that there was good, cheap advertising to be had on TV land.
Which show?
It was reruns of like the Andy Griffith Show, and these are reruns that aren't going to be very expensive to advertise on, but we're reaching a big chunk of our labor base.
What was your role?
So I was working on the youth turnout model. So so my job was to try to figure out how can we predict who from the ages of 18 to 30 is going to vote. And this is a tough challenge because your voter history record is
the answer there is no, right? Usually.
At the end of the day, that's basically what happened. Is that older individuals, we know if you're going to vote because you have a history of voting or not. But younger individuals, we don't have that history.
So how did you use big data to figure that out?
It was hard. It was hard. So the campaign had internal surveys, and these surveys ask polling, and these polling questions ask about turnout. It turns out that there's some stigma around saying you're not going to vote.
Right, of course.
So everyone says they're going to vote, and we know that's not true. So these polls were not terribly accurate. We tried doing some group-based analysis, some Bayesian stuff. We improved the models a little bit, but I don't think I was able to crack that nut.
Was Jon Stewart in the mix at all? Like, do you watch Jon Stewart?
I do watch Jon Stewart.
No. The people who watch Jon Stewart, would they go vote?
Well, I did watch Jon Stewart. And in terms of, we didn't use TV viewing data, in part because our model was built on a micro basis. So we were modeling each individual in 13 different swing states. And so we don't have, micro data on who's watching which TV channel. But from a group level, that's important. But, we're talking about young people.
So, Mohit, how'd you go from being a big data Obama guy to coming to New Haven to pursue an economics PhD at Yale, which is you're currently doing?
That's right.
And to be a civic volunteer to help us figure out our budget. How did that happen?
I've always been interested in policy. And I've really I've always wanted to try to make a difference in whatever way I can. So, I moved to New Haven for grad school about 4 years ago. And, pretty soon after moving here, reached out to the mayor's office and asked, how can I serve? And, FRAC is a great way to serve. So FRAC is a commission that's, we are 5 individuals. There are requirements in the charter to be on FRAC that aren't true for anyone else. So members of FRAC have to have a background in business or other financial experience. And I completed my MBA. So I was at Oxford. I completed my MBA there. And, a lot of what you learn, if you take your MBA seriously and you really try to understand the rules of accounting, the rules of finance, these things become pretty clear. And so I was really excited to be able to put my MBA training to use. And, that's not something you always hear every day. So I'm glad to be able to say it.
And what are you studying in economics? What's your...
So my primary area is the economics of education.
Oh, wow.
And I also work in the economics of healthcare. So Professor Joe Altanji and Jason Applelock over at Yale. Yeah, no, I'm really interested in looking at how, we have a growing, so for example, I'm working with the VA on a data set and
Veterans Administration.
Exactly, and trying to understand how information moves between doctors, and how do we know that physicians are fully informed enough to make the best decisions that they can.
So you're going to be up to a lot of great stuff we're going to be hearing about how to make our society better. But in the meantime, in between your studies, you're helping FRAC, the City Budget Watchdog Agency, keep a tab on the budget. You'll be, how do citizens get involved with FRAC?
That's a great question. So our next meeting is 5 p.m. on Thursday, meeting room 2 in City Hall. And then just watch the city calendar for our next meetings coming up.
And you'll be speaking up at City Budget. You get any pushback from city administration that appointed you that you're pointing out these problems?
Got a couple years left in my term, so not yet. And the auditors have been great. We've had great conversations. They've really been listening and trying to understand the issues.
Well, Mohit Agrawal, we're going to have you back because there's a lot to talk about, but we got to make room, I think, for Harry Jaros is next. I'm not sure. Who probably was not watching those TV shows you wanted to target in 2012. He watches different TV shows. But thank you for joining us in NHHFM's Dateline New Haven. Thanks to Mohit Agrawal from the Financial Review and Audit Commission and a person to watch in New Haven in our civic society, making a difference. We're going to take it out with the Afro-Semitic Experience, performing I Wish I Knew How It'd Feel to Be Free from the group CD, A Plea for Peace. Now, we know what it's like to be free. We just got to remember to book our flight. Book your flight with us all day and all night long here at WNHH, New Haven's home for community radio.